Welcome to the Deep Dive. Today, we're really zeroing in on something critical for, well, any Canadian entrepreneur wanting to be smarter with their money. We're talking about unlocking tax savings for your small business in 2025.
Exactly. We've gone through quite a stack of sources, articles, notes, research, all focused on the most impactful strategies you really need to grasp right now.
Yeah, and our mission here is to cut through all that complexity, pull out the key nuggets, and show you how some sort of foundational choices can actually open up massive tax advantages, things you might be completely overlooking. Honestly, there are some genuinely surprising things in this material.
That's spot on. What these sources make clear is that tax planning, good tax planning, isn't just a mad dash at year-end for deductions. It's actually core to your business strategy. It's built right into the structure.
Okay, let's unpack that foundational strategy idea. The sources really hammer home that the biggest initial decision, tax-wise, is sole proprietorship versus incorporating. Why is incorporating such a uniquely powerful move?
Because incorporation creates a whole separate legal entity. It's distinct from you, the owner. See, as a sole proprietor, every single dollar your business makes is taxed right in your hands in your personal rate, which, let's be honest, can climb way over 50%. A corporation, though, it has its own tax rates, and they're significantly lower on profits kept inside. That's separation. That's the key. It unlocks the biggest benefit.
Yeah, that's separation. So what are those big benefits the sources keep highlighting? What makes incorporating the game changer?
Okay, number one, tax deferral. A corporation pays tax, yes, but at a lower rate on its profits initially, so the after-tax cash. It stays inside the company. It's not immediately taxed in your hands personally at those higher rates. And that money can then be reinvested, grow the business.
Yeah.
Basically compounding at that lower tax cost. Just a really powerful way to build business wealth faster.
Okay, so the money you don't need right away stays put, taxed less, works harder. Makes sense. Makes a lot of sense. What's next? What's the other big advantage?
This one's huge.
Yeah.
And it's something the sole proprietor they just can't get access to it. The small business deduction, the SBD, the sources, they pretty much call this arguably the single most important tax trend for Canadian small businesses. It dramatically, and I mean dramatically, cuts the corporate tax rate, specifically on the first $500,000 of what's called active business income. That's basically income from your main operations, not passive stuff like investments.
Okay, so the SBD slashes the rate. Big time. What does that actually look like for 2025? What do the numbers say?
Well, federally, the standard corporate rate is 15%, but apply the SBD. That drops to just 9% on that eligible income. Now, add in the provincial side. That's where the difference becomes almost unbelievable sometimes. For example, the sources point out provinces like Manitoba, Yukon. They have a 0% provincial rate on small business income, so your combined rate is just 9%. Compare that to general corporate rates combined, easily 25%, sometimes over 30%.
Wow.
And yeah, the provincial details do shift. The tables we looked at show for 2025, PEI, for instance, is actually boosting its SBD limit to $600,000. Nova Scotia is reducing its small business rate. You really have to check your specific province.
9% combined.
Yes.
That's a staggering difference compared to potentially over 50% personally, or even those general corporate rates. That really is a game changer on potentially $500,000 of income.
Okay, what's the final big tax unlock that kept coming up?
This one's critical for the long game, for wealth building. The Lifetime Capital Gains Exemption, LCGE. For 2025, this lets you shoulder up to $1,250,000 in capital gains when you eventually sell qualified small business corporation shares. Now, these are generally shares in your own incorporated company, but they have to meet certain tests, about asset use, how long you've owned them. The sources detail that. Selling your business, that's likely the biggest financial event for most owners. And the LCGE means potentially pocketing over $1 million tax-free. And a sole proprietor selling their business assets, they get zero LCGE access. None. Wow. Okay. So the choice to incorporate really is fundamental. It opens doors to lower rates deferral, the SBD, and this massive potential tax break on exit with the LCGE. What about the practical stuff? What's the absolute non-negotiable foundation to make this all work and, keep the CRA happy?
Proactive. Meticulous, record-keeping. The sources couldn't be clearer on this. This isn't just tracking little deductions. It's the strategic bedrock. It supports your incorporation status, your SBD claim, maybe your LCGE claim years down the road. The CRA wants records for at least 6 years, and believe me, they need to stand up if they ask questions.
And what specific records did the sources really flag as, the most crucial.
Oh, detailed mileage logs for any vehicle expenses. Absolutely essential. Generic guesses, they just won't fly. Meals, entertainment, you need the receipt? Sure. But also why you spent it, the business purpose, who was there. And don't forget, usually only 50% is deductible anyway. Home office. You need solid proof it's your main place of business or used regularly just for clients. And back that up with a clear calculation, like square footage.
Right. And the material mentioned something about modern tools being essential infrastructure now, not just nice to have.
Yes, absolutely. Things like apps to snap receipts digitally, software that tracks expenses in real time, systems that link to your bank. These aren't optional anymore. They're your first line of defense, really, the CRA. They're using sophisticated data analytics now. They cross-reference everything, filing salaries, dividends, having accurate, organized digital records right now. It's essential to back up your claims easily and, frankly, survive an audit without tearing your hair out. Trying to do this all manually, it's not just a hassle, it's a genuine financial risk.
Okay. So let's bring it all together then. The way you structure your business, that initial choice, it's absolutely fundamental. It unlocks huge potential tax benefits, the SBD, the LCGE, that you just can't get otherwise, and underpinning all of it, dedicated, proactive record keeping, powered by modern tools, that's the essential, non-negotiable foundation.
Precisely. Getting your head around this sort of strategic architectural layer of your business, that's the key. It's not just about saving a bit on taxes this year. It's about genuinely building significant long-term wealth inside your Canadian small business.
So here's a final thought for you, drawn right from the sources we looked at. If getting tax efficiency right really is like an architectural discipline, what parts of your business structure's foundation might need reviewing or maybe reinforcing or even building from scratch, just to make sure you're really set up to capture every saving you possibly can in 2025 and well beyond?